what a reaction looks like on a 5-minute chart. Now, you want to keep in mind that when you are observing reaction levels or key levels on a medium-term time frame like a 1-hour chart, or even the higher time frames like a 4-hour or a daily chart, you will always want to scale down to a 5-minute chart in order to refine your entry or to hone in on that exact specific price on the 5-minute chart so that you have a better view of price action and where it is in relation to the most recent levels of resistance and support, or the most recent dealing ranges. So here's a British pound 5-minute chart, and we see just kind of a magnified view of a scenario here where we have, for example, we had this aggressive price move down, and the more aggressive the price move down, the more ideal it is to look for a reaction. Or the more aggressive the price move down, the higher the probability that we will get a nice reaction that can be a tradable reaction. So for example, this move from these lows to this high is just about 30 pips. And we see price come down and it continues to reject the lows. In the meantime, we have our RSI set at 18 with a high base of 60, a low base of 40. So the low base of 40 here is our oversold scenario for the short term, and we actually have been oversold for several minutes now, and as the market finds a bottom here, price moves back up above this resistance, which later becomes a level of support. And interestingly enough, as price moves down, I'll just show you one other point of note. You see here at 94.90, you see this level of support becomes resistance at 94.90. Then price reacts from 90 down to 65, and that level converges with this high. Unchallenged level of resistance becomes support, and again our RSI has moved into the oversold scenario. In fact, it's actually diverging at about the time that we see this price reaction off the low. So we see a price reaction off the low of 65, and it moves to 80 fairly efficiently. Looking at another example here, we see the market made a high, price has retraced. We see a RSI is oversold, price comes down, resistance becomes support, and we see a nice reaction off of that level. Now, this is a momentum bounce where price moves above the high, retraces, and that is a momentum scenario. And in a momentum scenario, obviously the RSI is not going to be a contributing factor in helping to determine whether or not you believe it is a viable trade, because we are now in a momentum scenario. We see price move up another leg, and by the way, these aggressive spikes up can offer very good scalping short trades, assuming that somewhere along this spike up we hit a level of resistance. We retrace, previous resistance becomes support, and interestingly enough, we have a divergence scenario here, which can also be a contributing factor to your decision. Price rallies, makes a run above the high, and it becomes weak and fails and then recedes, which is also another good trading opportunity. And this is where we have the divergence scenario expressing itself.